Welcome everybody to Learning with Lowell. Today we're continuing our Millennial Monday series on Tuesday, or Millennial Monday on Tuesday series. There's probably a better way of saying that. We're joined with Brian Bickett, who is a fee-only financial planner focusing on retirement planning. He's going to educate us on financial planning and all that stuff around that, make sure that we avoid the pitfalls and everything. And so I want to thank everyone just in advance for writing in and letting me know what you want to learn today. But so we're going to get into everything. But Brian, welcome to the show.
Well, thank you, Lowell. I'm really looking forward to our conversation today.
Yes. So the big one, and this was kind of surprising to me, but I think it goes to this point. When you look at like the top 6 or 7 things that millennials are facing today, financial literacy is a big one. Like people don't know a lot, which is fine. Like that's what we're here to learn. But the number one question ranked by semantic analysis was, can you just go over some financial basics for planning for your future and kind of like weathering the storm? So like a lot of people writing in were just like at 0. So what do you think about when it comes to financial basics and setting people up conceptually with a framework to just go through life without, too much stress, I guess?
Well, we can't avoid too much stress in life.
Yeah.
That's going to happen, and that's something we need to plan for. And so we one of the basic building blocks when we're looking at financial planning is we definitely want to build the framework so that we're comfortable taking on that stress when it does come. And so we always start with having margin or having margin in your monthly spending. Make sure that you're not spending every dollar or more that's coming in, and that you've got some margin there at the end of the month. And the next step is to take that and start building an emergency fund. We need a cushion for when life happens. We need someplace to be able to absorb that, and an emergency fund is truly the first place to do that. The general rule of thumb is 3 to 6 months of expenses. We start with what you can start with and focus on that, getting at least a month in there to start with, and then moving on to tackling debt. And those are really the first 3 steps. And if we can get through those, there's a multitude of more steps to walk through, but that's really the building that is acknowledging that there are going to be stresses in life, both personal and financial, and that having the emergency fund and margin in your monthly income helps provide a buffer for when those waves do hit.
Sweet. So working middle to backwards. So is there a millennialized version of so I think a lot of people have heard the 3 or 6 months rule, but but millennials, I think you're a millennial as well, but there's been like COVID, there's been 9/11, there's been like a lot of upheaval when it comes to like planning, and those things so far have not gone away in 6 months. Is this still a general good rule of thumb for millennials to just have 6 months, or is it good to have like maybe 9 months? I know like startups, for instance, a lot of my friends are startups. I advise a lot of them. A lot of them at like 6 or 9 months ago were told to like get to essentially revenue 0. So instead of like deficit spending to grow, to get to the point where they're profit neutral or like around profitability, because they expected a recession and terrible stuff to happen. They expected that to happen within 18 months, so like get things worked out. So is 3 to 6 month like really an optimal one for millennials, or is there a more optimal one for millennials?
The 3 to 6 months rule of thumb is a rule of thumb, but when we dissect that further, we want if you're a W-2 employee and have a fairly stable position and have had that position for a while, then 3 months might be the goal to start with. If I'm an entrepreneur and things are very volatile, then I'm definitely going to want to be further out on that, 6, 9 months, maybe even a year, depending on the situation. Anytime we're making financial decisions, we're making compromises. We have to make a compromise. So if I say that you can't go start, or that you shouldn't, I can't say you can't do anything, but if you shouldn't go pursue your dream until you have a year of savings saved up, well, a lot of folks will never get there and will never step out. And so at some point, we definitely have to make some decisions and a compromise of if we're going to step out on our own, and what level am I comfortable with saving up to. And so I could say ideally you want a year's worth of savings in an emergency fund, but truthfully, a lot of people would never reach that and never pursue what they feel like they're called to do. And that's to me is more important than checking a financial security box.
Yeah. And then when you have that security uh emergency fund, where do you store it? Because so like a savings account is like 0.000001%, and so you're basically losing money to inflation. So where do we store it where we're not just like giving the bank leverage to like loan out money and they benefit, but we just are like housing it somewhere safely?
That's a really good question. The truth is, anytime we put it in a savings account, regardless of the savings account, we're always losing ground to inflation.
Hmm.
Savings accounts are always going to pay less than what we're seeing with inflation or what true inflation is. And so the goal of that emergency fund, with clients, I refer to that as my sleep at night fund. But that money is not there to grow. It's not there to do anything but be that security blanket that allows me to sleep at night, knowing that I can go grab it if I need to. Something unforeseen happens, I can go get it. As far as where to put it, there's numerous, you know, depending on your local branches, some will have some offers, but if we look at like Ally or Capital One online, they've got money market savings accounts that are paying upwards of 4.5% to 5% right now, and they'll move with interest rates as well. And so those are no fee savings accounts, money market accounts, and that's where I have my personal savings sitting right now. And as rates have gone up over this last year, they've increased their rates as well. And eventually, at some point, rates will come. I expect rates to come down again. And when that happens, I expect them to come down at the same time or in lockstep with that.
Yeah. It sounds better than the point infinity 1%. The is it so basically it's just like it's like a savings account, like I can pull from it when I want. It's not like Roth IRAs or something where you have like a penalty for pulling out or anything like that. So
Uh,
yeah.
yeah, the money market accounts there's no penalty. There is a limit that I think there's a federal limit that you can only make 6 distributions a month out of it. And so
Mm,
it's an emergency fund, so you shouldn't be taking, if you're taking money from that, if you're pulling funds from it, then you probably want to do that in chunks as you foresee that you're going to need it over the course of the month. But other than that, there's no restrictions to it. There's no both of those places, Ally and Capital One, neither one of them charge any fees. There's no transaction fees. You link it to your local or wherever your checking account is, if it's not at one of those two places, and transfer it as you need it.
sweet.
Um,
And
you
then oh, go ahead.
Go
Sorry.
ahead. I was going to say you mentioned Roth IRAs, um, and I don't know if you want to talk about IRAs later on, but with a Roth IRA, one of the benefits of that is that you at any time can pull your contributions out tax and penalty free.
Oh,
It's not something that we advocate. You know, that's you should dip into a retirement savings account whenever that money is very accessible. However, one of the benefits is that you can your contributions you can take back out at any time, tax and penalty free.
all right. Well, thank you for educating me on that. I didn't know. This is fun, because this is such a fun topic for me. Because you don't know what you don't know, and I just literally threw something out there, and you like educated me in 2 seconds. So this is fun. Uh, the so when it comes to debt and margin, the nice thing about, let's say, college loans, which is the biggest thing that people have, is that there's a lot of programs out there that can tie it as a percentage of your income. So if you have like a large one out there, I think that's a lot of people don't know this, that you can get it, a smaller percentage, which is nice. But what do you think about college loans as it relates to debt in these first 3 steps? And I think the other thing is that I've read a lot about is people. I don't want to be like mean to say like mismanaged, but like their credit
Mm-hmm.
cards. I know a lot of people talked about credit card debt, and I think I'm gonna make that a part 2 question. Let's go with part 1 because like I
Okay.
have some like nuanced aspects of it because apparently that was like another big thing that people wrote in on. So when it comes to general debt, that could be student loans, mortgage, that type of stuff. I know there's like debt to income ratio. I don't know. How do you think about financial planning as it relates to debt? And then credit cards, let's keep that separate because apparently that's a big topic for people.
Yeah, yeah, absolutely. I think the general rule of thumb is that you want your mortgage and debt payments to be less than 25% of what your income is, ideally. And I know a lot of folks are stretched beyond that. And and if you're in that situation, then it's even more important to create some margin to start freeing up some cash flow to attack those, or a lot of times, it means making sacrifices of selling a newer car and buying an older one. And I know that folks don't want to hear that, but every decision we make financially is full of compromises. And so it really comes down to what the individual is comfortable with. I mean, I think that you should spend lavishly on things that are important to you and cut drastically things that aren't. And so for some folks, eating out is important to them. It's social. It's an important part of their lives, and so they spend lavishly in that area, but then cut ruthlessly on in other areas that aren't so important to them. Maybe they're driving an older car when they could purchase a newer car, but instead are spending that money on eating out with friends or family. And others are the exact opposite. And so for each individual, it's what's important to you is where you should be spending your money. And that's one of the things that we pull out of when we look at spending, monthly spending, is, are you spending money on what's really important to you? Is that the case? And if not, well then let's fix that, because it's not my job, it's not anybody else's job in the world to tell you what's important to you. But that's where you should be spending the money. In the areas that aren't, we should be cutting ruthlessly.
One thing that I was reading about, and a couple of people said in writing in, is that they get like a paralysis by analysis in terms of just like having a budget. So I think it sounds like, from what people were telling me, I've had a budget since I was like 7 years old. So like, I love budgets. I like knowing where everything's going. But I'm like that's like fun. But is there like a simple formula or an app or anything like that you recommend, preferably free, because maybe take away all of like the things that are getting in the way? Because I think if I was reading between the lines of some of the comments that came in, is there's just this fear like, well, what if I do the wrong budget and then like things don't work out or whatever, or I fall to scams, which we'll talk about that later. So like, what are some good? It could be rules of thumb, but I know like having a budget is definitely gonna be one of them. But is there an online resource, like download a budget spreadsheet? I know like Google Sheets has, like, you just click a template and there's a Excel spreadsheet, but then you look at that and there's like so much more than you need. So if we can help people out there, working through mental illness on this mental health, sorry, on this topic, how do we set up a budget to handle these types of things?
Most people, to your point, most people try and track at a level that's unsustainable and they track things that they're not going to take action on. So if we have 26 items, 26 different budget categories, and I'm tracking each one, but I'm not ever going to use the information out of one of those categories, then it doesn't do me any good to track at that detail. And if anything, there's so much tracking that I get frustrated and I stop doing it. And so then the whole thing blows up, is along the lines of what you had just said. And so I always recommend folks start with, regardless of what budgeting tool you use, whatever one is you're most comfortable with. Some people still write ledgers, still write everything down. Some folks are using Excel spreadsheets. There are a multitude of apps out there that have different, Mint is an app that you can connect to your checking and credit card accounts, and it'll import the transactions automatically. Credit cards have budgeting apps, so on and so forth. But regardless of the application, just starting with 5 categories, just starting with a housing, automotive, food, entertainment, and miscellaneous. And just for the first couple of months, just throwing everything into each of those 5 categories. And after a couple of months, you'll see, as you look at it, you'll see what falls in the miscellaneous and what falls in the other categories that are levels of detail that you want to track further. And so I advocate for starting with a very a lower number of budget categories, and based on the individual, if eating out is a problem, I shouldn't say it's a problem, but if I'm spending a lot of money eating out and that's not important to me, well then that's all showing up in my food budget. Well then maybe I need to break the food budget into groceries and eating out so that I can keep the better tabs on my eating out category and really try and track that at that level. But for other folks, they don't need an eating out a restaurants category because it all falls in food, and their food category is they're comfortable with, and there's, if I'm eating at a restaurant, then I'm not buying groceries, and they view it that way, and so that's not a level of detail that they need to track. But that taking that approach allows each individual to develop their own budget in a way that's useful for them. Does that answer your question?
Yes. And you
Okay.
mentioned you were specific on Mint being one that you recommend plugging into stuff that helps. And I like that you just kept like basically 3 to 5 categories that are really simple. And I think if that still seems like a lot for anyone out there, just like round, like it's like I went out and ate and it was like $24.93. Maybe it's just $25. Like just
Mm-hmm.
put it in there in a round category and make it really simple on yourself. Because like you deserve to have a budget and feel a lot better about your financials. So I was reading Rich Dad, Poor Dad as it relates to debt, and the I'm like, I don't know. So like one of his thoughts is that basically like debt is the thing to use to get to a better place, like to use debt in like a very weaponized way. So how do we use debt as a resource then? Or what do you think of Rich Dad, Poor Dad?
Robert Kiyosaki and Rich Dad Poor Dad is one of his books. That one specifically, and he's got a couple other ones out there. Are ones that I read as part of my personal financial journey before I became a financial planner. It was hugely influential to me to moving from being an employee to being self-employed. As it relates to using debt, I think that it's you have to weigh what happens. How should I say that? You have to weigh what would happen if you fail and how you're going to handle that going forward. I know many entrepreneurs that needed to take on debt in order to get things started, and things worked out very well for them. I also know others that tried to took on debt and started following their passion. It didn't work out, and that at some point led them to declaring bankruptcy and basically starting all the way over. But I also know folks who would never make the leap to entrepreneurship because they'll never feel comfortable enough that they have enough to make that leap, and they're not willing to take the risk of debt to help assist them in that. And so I'm not anti-debt by any stretch. If you think it through and you're intelligent about how you're using the debt and how much it is, and what the terms are, that you definitely can use debt, and most businesses use debt to get started.
Um, so for millennials out there dealing with the different, stuff out there, should they be, if there's like, I guess like a spectrum from being very liberal and having like a terrible DTI ratio and being very conservative and knowing that if something bad happened, they can still cover the debt financing or whatever that's going on. It sounds like we probably, given like potentially people's risk tolerance, to like edge on the conservative side. Are there good resources to learn more about how to use debt responsibly to get people where they want to go? Because it sounds like it's a useful tool and resource, but there are downsides, and there is a lot of stuff out there. I mean, I looked at TikTok today and typed in finance, and I was like, man, these people, they sound confident, but I like these some of these concepts. I like them less just from hearing them talk about it a little bit. So yeah.
I don't, the Small Business Administration is a place I'd point folks towards. They would help you make sure you've got a realistic business plan in place and a plan for how to handle the debt going forward. But I don't have any other resources other than above and beyond debt management would be having a mentor, having someone that's further down the road that you want to pursue, and having them help take their advice and help guide you as to in your journey, knowing that your journey is not going to be exactly like theirs, but someone who's walked down that same path before would be hugely beneficial.
Do Do you have any tips that you've used in your life to find good mentors? Like I think some people say, offer them like a coffee, like to pay them to bring them coffee or something is pretty good. But
Mhm.
like, do you have any like little things like that to let them? Because fundamentally, I think it's just letting them know like you're not going to waste their time. I think it's like, hey, I'm
Mhm.
asking for your help. You're a very busy person. Can I bring you coffee? It's like just shows like the little bit level of like interest. But what are some things that you do to like find, not find them, but like secure, I guess, good mentors?
Secure mentors. In the past, I've done just that. I've offered to buy them
Mm,
lunch, offered to buy them breakfast, bring coffee to the office, something where I'm helping them in some way. And granted, most of the mentors don't need someone to buy them lunch, don't need someone to bring them coffee, but you're sincere. And I think uh, being diligent and at least accepting their advice, even if you're not doing it down to the T, goes a long ways. And the other is even going as far as paying for an hour of their time.
mm,
I've had I should say I know of folks who have gone to people they look up to and said, I know your hourly rate's $175 an hour is what you charge for your service. Can I pay for an hour of your time? And here's the type of questions I want to ask over that period. And that opens the door that you are serious and sincere about that mentorship. And even though it might not be a formal mentorship ongoing, but that I think you just have to show that you're not wasting their time as much as anything. We all are very, very limited on how much time we have.
I think the one thing I'd add is to that is whenever someone gives you advice, just let them know how it turned out. Even if it's like a
Mm-hmm.
2 minute like email saying, "Hey, I really appreciate it. You said suggested these types of things. This is how it worked out for me. It's kind of cool. Here's something that worked out differently." Because I've like given people advice and stuff, and there's been a couple people where it's been like a thumbs up response, and like, "Oh, I'm never helping you again. You're on your own."
Yep.
It's like delete, going on with day. Which I mean, they went from like someone I would help to like not. So like a little bit of like think like if you gave someone advice, like would you not want to know how it went out versus like goes out in the world and never seen again. Um,
That's a
the
very good point.
so for I was reading that for a lot of the average American basically can't afford a $500 like random expense like a car, need tires or whatever it is. Um, I think it's like really a broad question, but when people are in that state, it sounds like we talked to some of the things that you should do, like find a budget, start, increasing your margin so you can put something away. And so, when people do, let's say, have $500, maybe it's like $100 a month, and like over the course of like following this basic stuff that we just mentioned, they can get to $500 a month or something like that to like weather these types of expenses. And they have their
Mm-hmm.
emergency fund. What do they do with the rest where it's still useful? Where like where should they think about putting it, that type of thing? So once they've reached that level, what should they do next essentially?
I think you have to do some soul searching
Mm,
and understand where it is you want to go. And for a lot of people, you mentioned before with budgeting, they get paralysis by analysis. That I don't know what I want to do next. I don't know what to do with this going forward. And so my advice is always to take a step in a direction, even if you're not sure which direction to go. We'll take a step in almost any direction. Will get you further. Will truthfully get you closer to where you will end up, or where you ultimately will want to end up. Because a lot of times we don't know what we don't know until we make that first step, and then can say, that's not the path. I see now that that's not the path I want to pursue. So now I can eliminate that option. I have these other 5 things I'm considering. Well, let's take a step in that direction of number one. And nope, that's not what I'm looking for either. Let's take a step in direction number two. And at least uh, every one of those steps gets you closer to where you ultimately will want to be. But you have to take action, even if it's 180 degrees in the wrong direction. That will tell you that that's not the right direction, and now you can move to help move you further.
yeah. Is
And so I mean, to me, it's as much about what it is that's important to you and what to do with those dollars. I think retirement for the baby boomers and what retirement looks like for millennials is night and day different. I don't, I don't, I think there'll be, the baby boomers idea of retirement for many of them is, I quit my job and it's a life of leisure after that. And I think with the millennials that there's not, you'll always be doing something. And I think that's important. Working with baby boomers as they retire is that you have to have purpose in your life. And, saving for retirement, I'm not trying to discourage people from saving from retirement, but we shouldn't pin all our hopes on 40 years from now or 30 years from now, then I'll be able to do the things I want to do. What can we do today to bring those forward? Because who knows what tomorrow brings?
Yeah. Is the I know Warren Buffett has like some type of, I forget the ratio of something that he recommends for like a stock index stocks or something. I forget the term for it off the top of my head. But when there is like everything's taken care of, he said to like put it in like an index fund and like kind of let it sit there and it'll take care of itself over the long term. Is that one of those paths you're talking about, like soul search and decide what you want to do? Or is that more like, do you want to build a business? Do you want to be more a part of the community? Do you want to like travel more and has that a ratio? Or is that what you meant?
The second part of what you said.
Okay.
If you're comfortable in your career and you're comfortable with what you're doing, and you don't have any other goals for that money, and you want to save it for something long term. I mean, at any time we're talking about goals within the next 3 years, we absolutely don't want to invest it in the markets. That's definitely not there's not enough time. If the markets have a decline, if 2008 happens, we don't have time in 3 years for the markets to come back. And so, really anything 3 to 5 years, we avoid the markets. But if we've identified a goal that's important to me, that in 10 years I want to buy a second house somewhere, or I want to be able to go on an annual trip somewhere, there's something that I've decided that's important to me that I can use money as a tool for. Well, then in that case, if we're going to invest in the markets, I agree with Warren Buffett entirely that we use index funds and not try and pick which stocks to buy, which stocks to buy, when to buy them, when to sell. The research shows that people get lucky from time to time, but overall, we have a horrible record of timing those. And so investors fare out much better over the long term if we can just buy into the entire market and let it ride.
Mm-hmm. I think it was so nice that people wrote in, like helps me like make the episodes and your time much more valuable. But one of the big things that people are writing in is saying that the first house is the big thing that a lot of people feel like they're priced out of it because their rent is somewhere between like 1,000 and 1,400, and so it's like, how do you afford both at the same time? When you're trying to like get things around. But when it comes to saving up, I think FHA loans like only need like 3% or something, which is less than like the normal type of loans. But how do you think about for millennials or for people listening, they're trying to buy their first home? How do we financially plan for that?
You've got to, of course, you got to make room in your budget for what that mortgage interest and insurance, or I should say mortgage insurance and property taxes are going to be. I mean, you've got to make room for that, but you've also need some margin. You need some savings because things are going to go wrong. Even if you were to buy a new house, things are going to come up. There's going to be a hailstorm. There's going to be a natural disaster that comes through, a storm event. The furnace is going to die. Something's going to happen that you're going to need some funds available. Even if insurance is going to cover it, you've got to be able to cover the deductible on the insurance. It might be a little while before insurance pays you. You need to be able to cover that time in between. And so I don't know that I'm answering your question exactly how you want me to, but what you're asking, or how you asked it maybe. But it's I think you have to be more financially prepared for that than people think, because that when that happens, when those things happen, that's when you start having to dip into credit cards. That's when you start having to reach for things financially, and that's a rough road to go down.
Yeah, is it enough? So let's say you have like the 3 or 4% down payment, and you have on top of that the 3 to 12 month emergency fund. Is that sufficient in terms of having enough money in for emergencies like you're saying, or should you have like if it's 3%, try to get like what is there like a good rule of thumb? Like how would you think about, or is the emergency fund built to that level? Would that be sufficient?
I think if your emergency fund's built to that level, that's sufficient.
Hmm.
Anytime you put less than 20% down on a house, you end up with private mortgage insurance, which costs a little bit more on top of, it's an additional expense. And there's ways to avoid private mortgage insurance. You can get a second loan for that second 17%. But it really, I know you want a rule of thumb, but it really comes down to the individual and where they're at and what they're comfortable with, the risks they're taking. Is it the time to buy the house now, or do I need to wait another year so that I'm more secure financially? Knowing that, and I absolutely believe we cannot financially prepare for every storm. There's things that are going to happen to folks that if we prepared for those, we could never prepare for them. So,
Credit card debt. There's many strategies on this. I think there was like a 60 minutes or something when I was in high school. It wasn't a part of high school at all. I just heard about it and it scared me a lot. If you have credit card debt, well, first thing I guess is like try not to have credit card debt, pay it off every month. But when you do have credit card debt and it's substantial, what are some strategies that you found to be effective in terms of like getting it off? I know there's like one where it's like you do the highest interest rate quick, or there's like the smallest amount if you have multiple credit cards or something. You do the smallest one first so you feel good about the fact you're getting something worked off. What are some strategies that you found to be effective if you're trying to just optimize for like destroying the debt, I guess?
Truthfully, there's so much behavior, there's so much emotion and behavior in finance that, I can run the numbers and show you that mathematically you're better off attacking the highest interest rates first, and paying the minimum on everything else. However, if you don't see progress and after 6 months, you're staring at the same debts, you've the big one that's at the high interest rate, you've made a dent in, but it's still looming out there. You're more likely just to give up and say this isn't going to work. And so what I've seen work best with people, even though it's not the most efficient way to do it, it's the one that gives us the best chance of actually following through with it, would be to tackle the smallest debt first. And then you see progress and you're encouraged to continue on.
So credit card debt, work it off. It takes time. I think another thing that I heard, and I don't know, this is me more just like checking to see if this is still a thing, but I'm told that when you get credit card offers, you should keep them. And then when you find yourself in credit card debt, you say, hey, this new credit card is offering me like 3 months off or like lower interest rate. Can you guys match that? Because I'm thinking like, opening them up instead. And they usually will like match you for that period of time. So then you have less interest or like an interest free period while you're handling stuff.
Yeah. I don't know that you need to keep those offers or not. I mean, that's definitely gives you alternatives in the event that they won't. If you need to move things from one to the other, that gives you an alternative. I can understand that process, but it's always worth the phone call to call the credit card company up and ask them to reduce the rate. The worst case is you spend 20 minutes on the phone and they say, no, we won't. There's nothing we can do, and you're where you're at. In the best case, they cut your interest rate, they cut your interest rate, and I think a lot of companies will do that.
Yeah, and it's very valuable if it's like 20, 30 minutes or even an hour. Imagine how much money you'll be saving, and that's how much you just like saved yourself. If you have like $5,000 and they saved you 20% a month, and you got that in an hour, like you just you have like such a massive if you were to like charge for that, there's such a huge amount of money. Especially if it's like over like 3 months. I was just like, I'm trying to like do the math while also deciding probably no one would be interested in that but me. So so you typically work with older generations, the Millennial series. You're trying to like, I guess you're seeing the results of people maybe not taking a more active look at their financials when it comes to planning for their future. And there is that difference you mentioned where like Millennials, where we want to be a little bit more part of the community, where it sounds like other people just kind of want to be like, well, I did my part. And that's cool too. Like whatever makes you happy. Because I mean, it's like like all life is variable. Um,
hmm
the as someone, so if we're looking at now and we're at zero, I know people always say like the best time to start is like earlier, but is there like if you only had like $20 extra a month and you're like you started this thing and you're like, oh wow, I have like $20 extra. Um, uh, is there a good way to like do you just like put that in an emergency fund and you just keep adding to that, or do you do anything with it? Do you open it up like an investment account, do the index funding or whatever? Like, is there like a minimal amount to really have coming in each month or to have before you start thinking about these types of things?
No, there's really not for that first when we're at zero. You know, the
Hmm.
adage about when the best time to plant a tree is.
Yeah.
Well, 20 years ago, and the second best time is today. And so we can't do anything about the past. We can't change anything about yesterday or before. But we can definitely make changes from here forward. And so if you've got $20 extra a month, I mean that's you start filling up your emergency fund. Life is going to happen. Things are going to come up. And a year and a half from now, you're going to have $120 in there. Or I'm sorry. In 6 months, you'll have $120 in there. And then invariably something is going to come up where you need that money. And it's a good thing you saved it. Otherwise, that would have went on a credit card to cover it. And so money is simply a tool to be used to help you pursue what's important in your life. And so I would never advise that somebody, or I wouldn't suggest or advise that if you got an extra $20 a month that we go and buy Tesla stock with it to start with. Why are we buying Tesla stock? I mean, what's the purpose of that? Um, and uh, and so I think that the money the money is simply a tool to move you
Hmm.
closer to what's important to you.
Are you the are you like the Tesla shorters? I was just reading about this the other day, where they think Tesla's overhyped, so they want to short it or something.
Yes, I'm familiar with that. I'm not a market timer in any way, shape, or
Mm,
form. I don't do that personally. We don't do that with clients. It's not. We
yeah.
buy into the market and get market returns at the least cost possible. And over time, uh, for on average, investors do better using that approach.
Yeah. Yeah. The oh, okay. So then it could have been any stock. It's like your thing. It wasn't. It could have been like
Yeah, no, I was,
Joe
yeah,
Schmo's. Yeah, I didn't know if it was like
no,
sometimes people are
no,
like I hate Tesla, so it's just like I was just asking
no, no,
because it
no,
seemed
no.
like a nice
It could
company.
have,
Yeah.
we could have filled it in with anything. Ford, Chevy,
Yeah. Yeah.
GM, whatever the,
Disney. Yeah.
yeah.
Yeah. Okay. And then I know you do like a no fee structure for financial planning or something like that. I don't have the specific part of the note in terms of like how you
Okay.
structure getting paid to be appreciated. So I did go through a bunch of forums. Like no one talked about this side of it because it's really nice. No one had a financial planner when they wrote in. So this is like very good information. The they talked about how like sometimes people would make a percentage off of how well you did, and then or like sometimes it was fee based or like there's like so many different structures. So when people are looking for a financial planner, how do they know they're fine? Like how do they suss out people like yourself are like no nonsense? I'm just trying to get you where you want to go
Mhm.
versus like I don't know. I imagine them in like $100 bill suits, like just like $100
Oh.
bills everywhere. So I'm gonna make you money, or like Dr. Quarters or something. I mean that's kind of probably a dead giveaway if they're dressed that way. Like where are they getting that money from? But how do we separate good financial planners from bad financial planners? And then structurally, is there like a fee structure of some kind that kind of lets you know if they're good or bad?
You're spot on. There's two, there's there's a lot of ways financial planners, financial advisors, get paid. Those compensation structures, can get really convoluted. What I would recommend for millennials, for anybody just starting out, regardless of your age, to be honest, would be to look for someone who is a fee only financial planner. And that is someone who does not, there are financial advisors, financial planners who they are compensated based on commissions on the products they sell. If I sell a life insurance company, I get a percentage of, I get a commission from that. If I sell a specific mutual fund, I get a commission of that. Not me specifically, but that financial advisor does. And that's how they're compensated. And when you're compensated in that manner, you're more influenced. That can definitely influence what your recommendations are. And so there is a category of financial planners that are fee only, and who are legally required to do what's in your best interest at all times. They have a fiduciary standard. And I would point folks to the Garrett Planning Network or the XY Planning Network. Those are groups. The Garrett Planning Network is hourly financial planners, fee only financial planners who charge just by the hour, and have that initial conversation with them and go from there. The XY Planning Network are fee only financial planners. The majority of them are certified financial planners as well. And offer, they have different fee structures as well, but everyone has to offer some sort of fee for service structure. So, you have the initial conversation with them and they quote you a fee. It'll be whatever the number is to put together a financial plan for you, or most of them offer hourly advice as well. And so that's where I would start with someone who their advice is not influenced by the products that they're recommending.
That makes sense. It's like, it sounds like they would be, and that was the big thing that you mentioned. The like their incentive structure is to sell you something that makes them money versus helping you make money and like manage your stuff.
Yep.
So it makes sense. It's like I always wonder when I see a problem, like how can we incentivize people to do the right thing versus like saying don't do that. It's like fiduciary responsibility. If there's a fiduciary person like you mentioned, and they do that type of thing of some kind, like they don't do something to your best ability, what does someone do? You just like report them?
Yeah, I would report them either to the state regulator or to the SEC, depending on where they're registered, and you should know that with whomever you're working with. And I mean, they're as fee only financial planners, they are legally required to do what's in your best interest. And so that's it's not when we're on the side of the table where it's commission-based products like life insurance policies or mutual funds, or that way, if you just go buy a mutual fund from an advisor, they get paid a commission from however much you invest. The requirements are there's a suitability standard. And so it just has to be suitable, as opposed to a fee only approach where they have a fiduciary standard. It has to be in the client's best interest. And so it's definitely a different level of care and advice for sure.
Yeah. What's the repercussions? Like you wouldn't do this, but like if someone did breach the fiduciary responsibility, do they just like get a fine or something? Like how serious is it?
It depends. It depends entirely on how significant the breach was. And so they could be fined. They could lose their license. They could, my understanding, you could end up in jail for doing that if it's severe enough. And so
yeah. When people are, I'm just like kind of following a line here. I don't actually think this probably happens a lot, but I'm thinking like Bernie Madoff, where it's like when bad things happen, people just kind of left without. So if someone were to give bad advice like this and they have a responsibility to do it, are people like made whole after that? Is there like a legal structure to like get what you lost back or like whatever happened back? Or is it just like you report them, they're punished, and you kind of like move on and like learn or something? Like what do people do when they're scammed, I guess, or whatever the term would be during these types of things?
I think, I mean, you absolutely report them. I mean, that's because what I think happens is if there's an advisor that's scamming folks, it doesn't just do it once, they do it over and over and over. And if you don't report it, and the next person doesn't report it, and the next person, it continues on. And so, I do think there are processes in place to attempt to make the client or the consumer whole. But it'd be based entirely on what the breach was, how significant it was, what the impacts of that were.
Yeah. And then there's like two, I saw these on TikToks, I think. Well, one of them I didn't. the whole everyone was talking about whole life insurance. Was like, why is this? How is whole life insurance an investment vehicle? But whole life. What are your thoughts on whole life insurance? And I have like a question on like trust, I guess. But what do you think? I did not think insurance could be investment, but yeah.
Uh, uh, in my opinion, life insurance should serve one of three basic purposes. It helps cover burial costs. It replaces lost income in the event someone passed, and it's an efficient way to gift money to a beneficiary or an organization. So if I knew that upon my passing I want to give $50,000 to the local humane society, a life insurance policy is a really efficient way to do that. I cover premiums, and when I pass, they're getting $50,000 regardless of when I pass. And so, as long as the policy is in effect, of course. I'm a huge term insurance fan because if we do the right things, we'll get to a point financially where we can cover burial costs, and we eventually get to a point where we don't need to replace lost income, and then there's the efficient way to pass money on. That could be a whole life policy if it needs to be, but a lot of times whole life or index universal life, and there's a whole slew of variants of that, are advertised as it's an investment vehicle. You can overfund the policy, and the cash value inside the policy grows, and then you can take a loan from the policy, and it's not a taxable event when you do that. However, anytime we take not just in finance, but anytime we take anything that was designed for a specific purpose and we modify it to do something else, it becomes less efficient. It's not as efficient as if we had just started from scratch and made something to do what we were trying to do. And so a whole life insurance policy as an investment is just not as efficient as if you were to do the investing outside of the life insurance policy.
What do you like about term life insurance? Why are you a fan of them? I think other than what you critiqued about the other ones, what is that? What does it do that? I think it's the one where you basically pay a premium for like a period of time that you set in advance, and then you get an amount when you die, as long as it's not like I think like they don't cover suicide or something. But yeah, what do you like about term life insurance?
We go back to what the purpose of the money is for. I mean, what this financial tool, insurance, life insurance, what's its purpose? Why do we have it in our lives? And for most folks, we need, if we're taking the approach of life insurance is to cover burial costs, it's to replace lost income, we don't need that for our whole lives. We only need it for a set period. And so a term life insurance policy, you do pay premiums for a set period, and the policy only lasts that set period. And at the end, there's no residual anything. It's very similar to your car insurance. I mean, you pay a premium every month, every year for auto insurance. And if you never have a claim, well, you lost your premium payments, but you were paying for the insurance. And that's a term life insurance. I would view that the same way. The premiums, if we took equivalent death benefits of a whole life policy and a term life policy, the premiums on a term life policy would be significantly less than they will be on a whole life policy. And that difference allows us more margin to do other things than have it all tied up in a whole life policy.
Is there, if someone's making like I think the average income in America is $38,000 to $42,000 a year. If they were to do a term life insurance, what amount would be good? Because I know there's like a variable you can like select how much. Mm-hmm. Like what would be like a good rule of thumb for that?
It depends on the situation. Am I responsible for somebody else? Is somebody else dependent on my income? And if that's the case, well, I need to work out what happens when I pass away. What's going to happen to them, and how much life insurance do I need to do what I or what we think they're going to need going forward. And for people in very similar situations, might have different the way the family. An example of this would be, I'll take myself personally. If we had a mortgage on our house, if if I passed away, well, I mean, regardless of the mortgage, if I passed away, my wife has said, I there's no way I could leave the house because all our memories are there. That's where the kids grew up. That's all. There's so much tied to the house. And for me personally, if my wife passed away, I don't know that I could walk back in that house again. I would definitely move onto somewhere else. And so that doesn't have anything to do with finance. It's all emotional, but we need to plan our finances around those two scenarios, which are completely different. And so when we look at life insurance needs, it's, well, we go back to what's the purpose of the money? I mean, why are we buying the life insurance? What do we need it to do? And then that we can back into how much you need.
Yeah.
And that is going to vary a lot from individual to individual.
Yeah. Then what do you think about trusts? I literally sat at a bank the other day because I was rolling quarters, which I'm very pissed off that my bank no longer does, like, you hand them change, they cycle it down, because that sounds to me like a financial service, and they did not have that service. But they were nice, but I sat there for like 30 minutes, because I had a huge change jar, and there was like everyone who saw someone, they were talking about trusts. So like how should people should the average person have a trust? Or when it comes to financial planning or whatever, like, how do you utilize trusts for retirement planning and what have you?
It just goes. I mean, it's another extension of what are we trying to accomplish. A trust, there's like 148 different types of trusts out there. Each one is structured a little bit differently, has different advantages and disadvantages, and so it goes back to what are we trying to accomplish, and then is there a specific type of trust that helps us move further in that direction? And so there's state rules that vary. There's rules for estate planning that vary from state to state, that in some states a revocable trust is beneficial, in other states it's not as beneficial. It really depends on the state you're in and what you're trying to accomplish. I mean, if I'm trying to care for a special needs granddaughter and I want to provide for that, well, there are special needs trusts that can help them financially without impacting the help they're getting from the government. And so that might be a situation where a special needs trust would be beneficial. If a lot of folks talk about trusts for asset protection, and that it just goes back to, I hate to say this, but you really need to have a conversation with an attorney on what it is you're trying to do and whether the trust is the right tool in the tool shed to do that.
Yeah. Well, you guessed what I was going to ask you. It's like, are you the person to ask these questions to? It sounds like it's a lawyer who you would use in conjunction with, like, after meeting with a fee-based financial planner to, like, really map out what to do after.
Yeah, I mean, I advocate for my clients that we have those conversations here, and then go to the attorney, and so we kind of flush out a little bit of the what we're trying to accomplish and get that squared away before you go talk to the attorney. Just the attorney fees are generally a bit higher. So,
yeah, when it comes to, there's a lot of really complex topics we're talking about today, and there's a lot of it depends because they're really complicated. How much time, let's say if someone's at 0 and they were to sit down with you, how long does it take to go from 0 to, like, we have a plan, it's all mapped out, and now it's just kind of executing on the plan and making sure it's good? Is it like you do it in a day, or is it like a couple days? Is it like an hour? Like, how much time does it take to get people financially literate enough and with a plan that meets their needs, that accounts for all that we're talking about today?
Some folks, I mean, I've had hour-long conversations with folks that provided them with enough information to move them to the next step, or to get them moving in the right direction to the next step. And then once they reach that step, they can either I can help them further or someone else can. I mean, to map out a full-blown financial plan, I mean, usually that's a couple meeting process, and we need to understand what you're trying to accomplish, discuss what the options are, and understand what you're most likely to implement, and then actually sit down and say, here's the plan, here's the action items and steps. It really, I mean, I think for most people, just an hour-long conversation with a fee-only financial planner would would be hugely beneficial to answer a lot of the, I don't know how long we've been talking, but to answer specific questions about my situation, about, here's my credit card debt. Do I tackle it this way or this way? And within an hour, you would have that answer, what the difference is time wise, as opposed to approaches to tackling it, and what the difference in interest rates or interest costs would be. And then be able to map out a basic budget. And I mean, a lot of that stuff you could do in an hour. And that would be hugely beneficial. Another, just taking the step to move in that direction. Most people don't need a full-blown, I don't think, most people need a full-blown financial plan, mapping out what's going to happen over the next 40 years, because life is going to happen over the next 40 years. And the first time a life event happens and it blows up the plan, well, it didn't matter what we had forecast to happen 40 years from now. A year from now, things changed, and now the plan's completely obsolete. And so for a lot of folks, we just need to get them moving in the right direction.
Yeah. And also it sounds like a lot of people have like limited vacation days or whatever to do stuff like this. Sounds like the next time you go, like, take a sick day or whatever it's called, to get a day off to go to see your doctor, maybe when you're done seeing the doctor, you see a financial planner, like, group it all into a day to be time efficient.
And let me, sorry to interrupt, but a lot of fee-only financial planners, especially in the Garrett Planning Network, XY Planning Network, those folks will have very flexible schedules. Well, they'll have one night a week where they'll take virtual meetings in the evening, and so it doesn't have to be a whole. It's not like a bank where it's only open from 9 to 5 or 9 to 4. There are planners out there that will meet in the evenings around your schedule as well.
Yeah. So what are some things that people should have prepared to talk to a financial planner, to have a good hour with a financial planner? Is it like bank statements? Like what type of like resources would the average person have that they should bring so they can have like a meaty conversation?
Most recent tax return, because that's very revealing in and of itself, and then bank statement for the last month, and then anything that you have questions about. If you have a 401k at work and not sure what to do with it, well, then bring your 401k statement in, and if you've got money sitting in a savings account or in a CD somewhere, well, I would bring that statement, and that's one of the things I would ask: is how does this, is this the right place for this? Where does this fit into the puzzle of my financial life?
And then you mentioned how you can't really plan for emergencies, and I know like that's one of the big things that got you into financial planning. That emergency happened, something very sudden that you didn't see coming, and it really shifted. I mean, put you on a different track in particular. But if when it comes to sensitive things, I just kind of like set the groundwork and let you go forward, because I know it's a very sensitive story. So what happened that led you to where you are now?
I'm a mechanical engineer by training. I got into software consulting, and we got a phone call one January evening saying that my father had a very aggressive brain tumor, and that changed the trajectory of my life entirely. And so we did treatments. We live in South Dakota. My folks lived in Wyoming. They came over and did treatments in the town I'm in here in Rapid City, and stayed at our house while they were doing it. We would go home. I would go home. My daughter Ellie and I would go to my folks' place on the weekends and do things around the house. But we just had my dad ended up passing away in May, just 4 full months later, and it was walking through helping my mom financially after that. Really prior to it and after it, there was a day we were over there on a Sunday, and my dad looked at me and said, "I want to make sure your mom's okay." And mom burst into tears and ran out of the room. She didn't want to talk about finances at all, but dad wanted to know if he had done his job. Is your mom going to be okay? And after a couple of weeks of digging through things, we didn't have our hands on everything, but we had enough information that I was able to tell dad that mom's going to be just fine. And you could physically see the weight come off his shoulders. And he passed away within the next month. And after working with mom and getting everything taken care of, put together, I did a lot of soul searching as to what I was called to do here on Earth, and arrived at, if I could help anybody else, help prevent anybody else from having to go through that. If Dad would have had just a financial binder, I never would have had to have seen it prior to needing to see it, but just knowing that he had all his information in one place, life insurance policies, investment statements, recent bank accounts, last year's tax return, all that kind of information just in one place. Or if they had worked with an advisor or a financial planner, on that, he asked me that on Sunday. On Monday morning, I could have picked up the phone and called, Imagination Dave and said, Dave, is mom going to be okay? And he would have said, yeah, she's going to be just fine. Don't worry about that. Focus on what's important right now. And Dad wouldn't have had to go through those 2 weeks of, is your mom going to be okay? He would have experienced that much sooner, when he should have been he should have been focusing on other things. And so that really, about a year and a half later, I stopped consulting and I transitioned to be a financial advisor. And my mission and purpose for doing that is to help other people prepare for those life events that we don't see coming. And it's happened, not countless, but so many times with clients where we just had, there's one this summer where, we're planning retirement. They're retired, and then one of them passes away unexpectedly. And now the whole thing's up in the air. And, along with the financial issues, we're dealing with all the emotional issues with that. And so that was really my impetus for getting into financial planning. I started out as a commissioned financial advisor because that's the only thing I knew. I didn't know there was another path. And I eventually was introduced to the fee-only side of the business. And I sleep so much better at night now, knowing that I'm not influenced. I'm not making recommendations based on, mutual fund A pays me 5.75% and mutual fund B pays me 4.5%. Well, guess what? All my clients are in mutual fund A. And I have a really hard time with that. Whether I wanted it to or not, it still influenced the recommendation. So, I don't want to monologue too far, but that's really the event that got me into financial planning.
Is there anything, when it comes to those types of events, like we talked about credit card debt, budgeting, knowing where you want to go, having a financial plan, is there anything that we haven't discussed that you think, like, man, I wish I would have had in place, or that people that you've helped with going through situations like that you wish you had in place, that we haven't discussed?
No, I think there's two things that come to mind. We talked about margin, and I think margin both financially and with time. It's such a, it seems like everybody is busy. Like that's a badge of honor that I'm busy and I don't have time to do things. But I think, it's important to get to the point where if something's not a hell yes, then it's a no, I can't do that. And if it's, we need to have margin in our lives, time wise as well, because life is going to happen. And having that margin financially helps buffer us. The idea of a financial notebook, of just having, and it doesn't have to be a notebook, it can be a binder, it could be a manila envelope, just something that somebody else knows where all your financial information is. They don't have to know what's in it, just that they know that if something happens, hey, on the shelf behind me, there's a folder that says whatever you want to call it. If something happens to me, that's where you go, and that's got everything in it. Then it makes, when life does happen, and that's an emotional event as well as a financial event, it simplifies the financial aspect of it. If someone passes unexpectedly, you got enough emotional stress to work through, let alone add on top of that financial stress of, is there anything how is it structured? What does it work? What do we need to cover? How do they just having all of that in one place and having someone knowing and someone knows where to go get it.
Yeah. Is it good to keep it in like a security deposit box? I know those are pretty. That's where a lot of people put stuff. I've never had one, but I just know like sometimes people recommend them.
Yeah, I think security deposit box is fine as long as or as good as long as that other person has access to it.
Yeah.
I mean, you both need to be on the security deposit box.
Well, no, sorry, go ahead.
No, I was gonna say a fire safe at the house. You know, you can buy a little. I don't know how big they are, 18 by 18 by 18 fire safe, and have it at the bottom of your closet with your information in it. And somebody else knows where the key is, and that can serve the same purpose.
The Since you have a background in software, I think you'd appreciate this concept. The idea of you have like one copy of something, you have like three versions of a thing, like one locally, another one locally, and then one like on a third location that's safe, so like nothing happens. Do you recommend, let's say, just taking the optimal of a binder? Do you recommend then getting that duplicated and then doing that same thing where you have a backup of it, and then you have one offsite? Is it like that level of security would be great, or is that unnecessary?
No, I don't. I think that's great. It's just if we can get people to do the first step,
Yes.
we're covering so much ground. But yeah, absolutely. If you can have a second copy somewhere, a digital copy. I mean, that's just I don't want to prevent somebody from doing it because they're like, well, now I got to make 3 copies and I got to scan everything and I got to come up with an electronic copy. But yes, to your point, absolutely. If we can have some diversification as to where things are at, if something happens to one, it's in other areas. That's absolutely beneficial.
Great. And then financial literacy. We've talked about some books throughout, and some resources. But wait, actually, I remembered. I circled this. Career as a financial planner. So it's like a two-part thing. Is there like a glut of good financial planners? Like, do we need more people going into it? And if so, what's it like being a financial planner? Because like sometimes people listen in and they're looking for a career that they can love with a passion, and it sounds like you have such a huge opportunity to help people every day. So like in terms of like value and spending your time wisely, it sounds like a great career. But it's like teachers, for instance, like having great teachers, we definitely need tons more of those. Do we need is financial planners like lawyers where we have a lot of them, or do we need more of them? And is that an opportunity for people listen in as a career?
There are. I would say there's too many financial advisors. I would say there's not enough fee-only financial planners. Making that distinction. There's not a shortage of people that are willing to give you advice for if you'll buy the product they're trying to sell. There's a lot of those in the world. I would say there's not enough fee-only financial planners that are that their advice is not dependent on the product or the recommendation that they're making. And I think it's a wonderful career for me. It's to be truthful, I look at our children and say, is this what I want one of them to follow into what I'm doing? And if that's a passion of theirs, I want them to follow what's important to them, what they feel called to do here on earth. And if that's financial planning, I would definitely not discourage it. I would strongly encourage it. It's a very impactful. We have conversations on the couch. There's many times where couples, it's painfully obvious that they've never said something to each other until we're sitting in the room and I'm asking them questions, and we get to a point where they're saying something that they hadn't told their spouse before. And so it's a hugely rewarding, emotionally rewarding career as well.
What does it take for anyone listening to? Because it sounds like you definitely want to skip the commission type stuff and go to fee only. What's it take to be a fee only financial planner? Like, is a certificates, education, training? Like, what is it like roughly? What does it take? And then if there's like you can apply a time amount to like go from like, hey, this sounds awesome, to like now actually doing fee based thing. So like, what would be your answer to that?
I mean, the legal requirement is simply that you pass the Series 65 exam, and you can become a fee-only financial planner. I would argue that passing that exam doesn't put you in a position where you're you're qualified to give advice to folks. And so I would encourage folks to either pursue the financial planning bachelor's degree. There's masters now that you can get in financial planning throughout the country. At the very least, to pursue the certified financial planning or certified financial planner certification. There's 6 courses you walk through, and then there's a capstone course where you build a financial plan, and it's critiqued and graded by financial planners, and then you have to pass a comprehensive exam before you can become a certified financial planner. And I think if I had to start it all the way over, I would look for a fee-only financial planner to work in their office to start with. And even if it was just, it was an entry-level position where I'm even at the front desk, make scheduling call or scheduling appointments, doing administrative work. There are so many different parts of being a financial planner that it really is beneficial to have worked in all those areas before giving real advice to clients. So
yeah. And then back to financial literacy for our last question. What we talked about some books, we talked about some resources. What are some further ones that you recommend people check out? It doesn't have to be just financial. If you have like some fun ones that you just recommend people throw in, like a fantasy series you like or whatever, like I'm always looking for new things to read. As you can see, like by my book section, that's very eclectic. There's like Blood Meridian over there next to like The Hobbit or something. But what are some financial books you recommend or resources? And then what are some general books you recommend that you think would be fun?
Whether you like Dave Ramsey or don't like Dave Ramsey, I think if you pick up one of his baby steps books and work and read through it and decide which one of those and decide how you want to apply some of those. I don't agree with everything Dave Ramsey says, but that's a very good template to get started on your journey. I think that's a good place to start. If you've got children, there's a book called The Opposite of Spoiled with Ron Leiber is his name.
Can you show the books? Because I know they're in front of you. So yeah.
Don't know if you can read that.
The Opposite of Spoiled.
It's an excellent book on how to introduce financial concepts or the concept of money to your children. And it's one that we use with our family. He uses the give, save, and spend jars, and we work through. And the book walks through how to implement that, and it's hugely beneficial. As far as overall life, when we talk about finance and what's important, this book it's called Enough from John Bogle. John Bogle is one of the founders of Vanguard, and this book is really good on what's really important in life. It's not always about more. That book is good with that. And then personally, on a day-to-day level, this book, Atomic Habits, with James Clear, the concept of habit stacking and his approach to that has been life-changing to me. It's been hugely beneficial. And I could grab more books, but I think those are four that would be good to start with.
Thank you for saying hell yes to being on the show today and for sharing this extremely important knowledge. Brian, thank you so much for being here today.
Yeah, thank you, Lowell. I've enjoyed the conversation. Appreciate the opportunity to increase financial literacy, and just thankful for this time, and appreciate you being here this morning. Thank you.